All right, everybody, Mr. Anderson here. Today we are going to talk about stochastics. So we're right in the middle of our moving average series, and we're going to continue to go deeper and deeper, and the next part of that is going to be a deep dive into utilizing moving averages and strategy. And therefore I want you to have the stochastics now. See, the way I kind of try to lay everything out for you guys is to put you into a position that if you only have what we utilize so far, you'll be okay with it. You know, you're not missing something so desperately that you're going to miss because of it. So with stochastics, we could have introduced it a little bit sooner, but you did have RSI. There's some similarities there. They're both momentum indicators, right? So stochastic is a measure of the momentum of price. But it does it in a little bit of a different manner, and we're going to talk about that specifically. Now, we'll talk about the positives of stochastic. We'll talk about some of the differences that you might see between stochastic and RSI. We won't go too deep into that, but I'll show you a couple of them. And we'll show you why you don't want to base things on stochastic and RSI, meaning that if they're in agreement, it doesn't necessarily make it stronger, and we'll talk about that as well. But what is stochastic? You know, first of all, if you want to pause the video, type stochastics in. There's 100 references that will probably give you a better breakdown of the math behind it. Basically, what we're looking at is a measurement of range. I'll give you a very brief explanation so that you have it, but I don't want to make the video long because I know that you guys all interpret things better in your own way. You might want to read it. You might want to take notes on it. So if you want to do that first, if your mind works in that way, which makes perfect sense, there's a lot of people like that, then it might make perfect sense for you to then go ahead and take a quick look in terms of what that is and go from there. Let me first go ahead and get this guy out right there. Okay. Very simple. What is stochastic? Well, in this example, this is the slow stochastic, right? Which is the only one I care about, which basically has a 14 period. You can change that around. I wouldn't play with that right now. I would just stick with the 14. But ultimately down the road, if you see that you have a interest in 20 or 10 or 5, you know, there's some advantages to there that you might like, and that's okay. Very simple. This is 14 periods. So it's looking at the last 14 periods. It's taking a range, right? It's taking a range of that period, and also looking at how the closes factor into that. So if you see a lot of closes that are high, see how it's closing near the top of the range? Not this one, but you had 1, 2, 3, you had extended range and high up in that range. So the fact that it was a large bar and it extended higher is giving this the ability to range higher. Very simple, goes from 0 to 100. They call 20 oversold, they call 80 overbought. You know how that goes. That doesn't mean that it's overbought or oversold, but we're going to get very specific into that right now today, so don't worry about that. And that's basically it. Don't think too much further about that. You can look into it if it helps you to know more about it and understand, you know, who made it, why they made it. Feel free. But for the purposes today, we're looking at the idea of this thing is to measure momentum of price. Okay. So we got price. As we truck along, what happens? So here we're looking at the last 14 periods, right, up until this point, and we show that we had an uptrend followed by some pullback, and that's reflected here as well. So the idea is to give you a quick glance. Another idea here, so 14 periods, so you took a little bit lower hit, but then a straight run up, and that's why stochastics is at its high for that period of time. So it's self-explanatory. These are things that you can obviously see visually with your eyes, but it is much quicker to visually see it with stochastics, and that you have an understanding. And remember, momentum before price, right? So what the idea of momentum before price is that ultimately we know we're going to get insight to the fact that the momentum will typically change before price changes, okay? Now, sometimes it's not so easy to see. You know, we'll talk about some of those examples, but the idea is that, you know, in a situation where you have momentum before price, ultimately you can find yourself in a scenario ultimately where you might be able to see that turn, and that can help you to say, you know what, wait a second, from what was looking like a beautiful trade, if I notice that the momentum started to wane, I might take a step out, I might wait a little bit, I might consider that and say, well, wait a second, Here, momentum's starting to get maxed out. What's going on up here? Oh, a little bit of horizontal resistance in this area. Dynamic resistance of this white 55. There's a lot of things that could start to come into your mind at that point. But I'm also going to teach you today very specifically what to look at in reference to that. So that's just a quick understanding of what it is. Now, I'm going to tell you why it's important, especially as it relates to something like moving averages. The idea is this. The oversold, overbought, just completely misused always. They're just unbelievably misused, and we're going to talk about that as well. But a couple things. First of all, I love Stochastic for bear and bull divergence. I love it. And it works very similar to how the RSI works, as you guys are aware. But the big mistake that people make, and here's what they don't understand. Let's just focus on Stochastic. Get a big screen of it. And I'll tell you the error. If you research it already, you'll see how what's called a percentage K. That's actually the stochastic. The percentage D is just basically a 3-day simple moving average of the percentage K, of the stochastic. But what people don't realize, you will have a hard time finding people that understand this. The divergence in stochastic is measured by the percentage D. Everyone does it. I don't know why. They go by the K, and that can throw you off in a big way, right? We're not daily scale, so you might not find as many examples, but trust me, they'll be around. And let me just go ahead and click in here. Go ahead and give you some price ideas of what we're talking about here. So the idea is pretty simple. It's to find yourself. I'm going to go to a little bit of a lower time frame. I know we're on Bitcoin right here. We want to find divergence, right? And you know how divergence works for the most part. If not, we're going to go over it. But ultimately, today's move turned out to be divergence. We'll see how it plays out, because I do like my divergence to be a little cleaner, meaning I do like it to give us a little more time. Let me just draw this out, and then I'll go ahead and show you what I'm talking about. So one, I like a short divergence like this, right? You might see these drawn sometimes. You might say, well, wait a second, this doesn't make sense. Well, it peaked out here, right? And then we lost the momentum. So this is a good sign because it's bear divergence, very close, right? Very close, because sometimes when you get deep into this, yes, it's great momentum divergence, but it's probably happening on a little bit of a larger scale. Because remember, these are 14 period look back, so it's understandable that there's divergence when you're further back than 14 periods, because it's only comparing that range instead of actual candles that are related. So the idea is that I would like to see a shorter term divergence like that before my longer term one, but this one was in a situation where certainly it is divergence, there's no way around that. The thing I didn't like is that, how clear was it? Yes, it was clear that, hey, this probably wasn't going to exceed up to here, so that would be fair, but you never really know. So I'm not saying you would have caught that. I know we have some members that caught them, so great job doing that. But you can also use things like the RSI and things of that nature. We'll look at that in a minute to basically find divergence. But in this case, the same situation, right? The divergence is a benefit, right? So what does it tell us otherwise? Well, we could look at things like this and say, all right, well, this was a very healthy move, right? We're here, we went to there. Okay, well here, same thing. Momentum is ahead of the previous momentum. That's fine. Everything is in a well structured. Now the fact that it resets, is that bearish? Not at all, right? There's nothing bearish about that. It's something that's beneficial. Now this, though, would tell you what? Now it's good distance apart, so again, in all honesty, I would go ahead and raise my time frame in a situation like that, but I'll take a look just to see how it looks. And let's see. Alright, so it looks much better on this. So what happens? You get price making a lower low, right? And your indicator making a higher low. Perfect situation, right? That is perfect divergence on a scale, meaning at a higher scale, like a 12-hour, 24-hour, 3-day, 2-day, all these different scales. It's very beneficial to see that. Remember, we're looking at the orange line for our divergence. So I love divergence on stochastic, and what I like about this one is you basically had a reversal, a pivot here, a recross, and we'll talk more about this in a minute, so don't worry. The recross, happen. You know, basically getting close. Didn't quite occur, but you had some bullishness in this place to where it was very possible to catch this on a 12-hour. And the nice thing about a 12-hour candle, you know, you might see this cross even if it was a little late. You know, maybe that happened here. You know, at this point, and you said, well, geez, the candle's not going to close for 10 hours. I might not wait 10 hours to take my trade. I see divergence clearly. It made a lower low. It's not going to make a lower low now, you know, ultimately. Now, sometimes you'll be wrong on that. That's fine. And in which case, you would have a very tight stop right here anyway. But ultimately, the key is momentum before price, right? So we see a shift in momentum. And it's on scale, on a 12-hour scale, that here we are with a sharp pullback, curve around, lower low, while the indicator's saying, hey, the momentum's not in a bad shape at all. You get a little bit of push forward. So that's the idea that I'm talking about in terms of some of the benefits, and you can roll through that all day long and find them. You could find them on low scale. You know, now if we get into like a 15-minute, then you're going to find them all over the place, right? We want to get rid of this guy for a second. Okay. Now, I will do another video of stochastics so you guys know. That gets into a little bit more detail in terms of some of these divergences, because there are a couple different types of divergence plays, but I don't want you to focus on that, because I feel if I get into that, you know, there's some that are like a bullish setup and a bearish setup, where basically you can basically get insight to where you see a bottoming type formation and know that, hey, I'm probably going to have one more leg down, and then after that next leg down should be a nice run. So this is actually a setup which I'll explain later, but if I tell you about that, you're going to be so interested in that little detail, even though it's minor and simple to get. You'll be focusing on that instead of learning stochastics specifically. So don't worry, that video comes after we go further into the moving averages, because reality is I want to focus more on the moving average strategy and how it plays a role with these particular with this particular stochastic indicator. Okay. And right now, you know, we can add different things, obviously, but today we're just going to focus on stochastic and price, along with moving average. We might add a little bit of RSI just to do a comparison, but again, I don't want the video to go too long, so we'll see if I can get to that. But the idea is that, so now on lower time frames, if we look closer, what do we see? I mean, these are going to be quick, right? Because this is something like a 15-minute scale. But look at this. This is a perfect example. My orange line makes a nice high. Okay, things were going fine. Let me zoom in on this so that it's not so... You should see this and say, oh, wait a second. Okay, this is better than I thought. Because the reality is, again, if I'm being honest, I like stochastic divergence better than RSI. And I'll show you why. RSI catches some divergence that stochastic simply does not. But I tend to have a little more faith in a stochastic divergence. When it appears and when it gives us a smooth signal. You know, sometimes the problem with stochastic divergence, as I mentioned, is that sometimes you'll get that sign, but it actually dumps on that candle, and then oh well, what can you do? You can't win them all. That's basically how it goes. But I do like this aspect. So look, you had a nice stretching high. Okay, then it's going to take a break. Price held up pretty well, right? Price held up excellent, actually, and then it bolted up again. But interestingly enough, what occurred? We see the momentum just simply could not get to that level. Now, granted, it got up to a very high level. This is 97 on your 3-day simple moving average, but ultimately couldn't get there. So this was a perfect sign of some divergence. Now, was the play humongous? No, but what do you see? Certainly a pullback, right? So this is low scale, of course, right, as we mentioned, but the idea is that when you find these divergences, it's going to put you into a positive situation. So here's another one. Very simple. Stretched out, nice, okay, everything's going well, nice pullback, a recross, stretched higher again, higher high, everything's fine, right? But look at where your stoke is, right? It's right over there. And you had a bear candle. That's an extra signal for you. That's nice when you get that. So this, you may not realize it, but I'm not saying you had to catch the top, but if we're going to measure what this was, we're looking at, on a very low scale, in an uptrend, almost what are we looking at? Of course, I'm forgetting the fact that Bitcoin's in this tiny range, but still 28 points. So you can imagine if you see this now on a 1 hour, 4 hour, 12 hour, you're looking at bigger things. So quick moves, bam, bam, bam. That's nice. That works out perfectly. and you could find very solid divergence in that regard. Okay. All right, so utilize the same type of ideas that you do with your RSI divergence. You can use an RSI divergence cheat sheet. I'm sure you guys you can use that divergence cheat sheet, which you guys have. If you need me to provide that, I can. I know a lot of you guys have that already, and you can provide it for each other as well. And I have put them up there previously, but the idea is pretty simple in terms of how that process works, and we're gonna now get a little bit deeper into a strategy element of why it matters. Because what I have on the screen, I'm sorry, it's going to keep popping up for a minute here. What I have on the screen is a pair of 200 EMA and MA, right? So this is our 200 moving average. And this is just our 8, 12, 26, 55 that we spoke about in the most recent video. And the reason I have it, just to review, 200 moving average or EMA, you don't have to put both. You can put one or the other if you have a preference for that. That's fine. I put them both typically, especially those two, just because some people use the EMA, some use the EMA. Sometimes price will get kind of caught in between there, and I want to know that. Ultimately, in an ideal situation, you want to see them both above or both below. The benefit is if they're both above, if they're above both, and you have an upsloping 200, and you have an upsloping price, on that scale, you have an uptrend. Meaning on that 15-minute scale, consider that an uptrend. Nothing else. You have to consider it an uptrend. That's just reality. So always remember that. Ultimately, you're in a position to where if you're above this 200, the 200s are upsloping, prices above, then you're in an uptrend on that 15-minute chart. Now, obviously, the scale could be a terrible bear trend, but this is a good way to look at a couple things, and it's very important. And then if we go back in time a little bit, I know this is a low time frame, but it gives us a lot of data, so that's why I like to use it. You can see right here, we're in a downtrend. And I'm going to show you why this matters. This is very important, guys, okay? Because you always hear me talking about pick your time frame, right? Let me clear some of these out just for a minute, because I don't really care about the other moving averages just for this example. And I want you to focus, because there's a big difference between calling something overbought and oversold based on these two lines, okay? This is standard. This is something people have used for ever and ever. And here's what it is. Stochastic overbought, right? Stochastic overbought. See what I'm doing? Stochastic overbought. Supposedly, right? That's what they say. Now, so far you might say, alright, that looks pretty good. I mean, you had a cross here, it had a little bit of a pullback, ran back on you. That's actually going to happen at times, that's fine. And then what happens? You stretch out, clearly overbought here, right? Recross. Very simple. Recross means the stochastic blue line crosses its own SMA line. So that's basically going to be looked at as a negative. Crosses down, and you're in a situation to where you had a healthy pullback on this scale for a 15-minute. Here, let's check out this one. All right, same thing. Did well, right? You're not expecting it to die. It's just a pullback, right? So that did fine as well. How about here? Cross right about there. Okay, came back very little. We see a recross on a bull side, recross on the bear side. Now, interesting, this one not so good, so I'm going to highlight it. I'm doing this on purpose so you know this wasn't a surprise or anything. Now let's go forward. And we're in a little different situation. Here we're trying to regain these lines, right? So I wanted to get to a position. You know what I might do is, someone was talking about Litecoin. So I'm going to actually switch gears on you. I apologize. I just showed you that example, but because a couple of you guys were asking about good old Litecoin, let me go ahead and give you good old Litecoin. Now, I don't know if you're looking at Litecoin Bitcoin or Litecoin USD, but either way, it'll work out fine. Okay. So, Litecoin. Let me go to a 1 hour and see how it looks. Apologize for switching up, but I want to give you a solid example. This Litecoin's one that really climbed, got over its moving averages here. think this will be perfect. Okay, so this is a 4-hour chart, right? Now, what am I looking at? Again, I'm going to do the same thing, so forgive me for being repetitive, but here we are. Look, overbought Stoke. You can see pretty clearly that when you measure it, the cross was about here. You had to pull back. Okay. Beach overbought area here. Crossed over. Yeah, wow. Overbought Stoke is a great tool, right? Here, you did have some trouble, but it wasn't so dangerous. I mean, the reality is the first cross gave you some profits. If we zoom in on that, I'm sure you'll see profits. Just like that. And then you had a recross, could have got you out, so you actually would have had a profitable position. Had the bear cross again right about there, that you would have got caught up a little bit, but then if you were patient and waited for that one as well, that would have been a monster win. So hey, overbought does seem to work, right? So now let me fast forward. This was the example I was trying to give you before on Bitcoin there, but it's going to work better on this higher scale. All right, now let's go ahead and see what good old Litecoin has done. Oh, right here. Overbought, right? So this thing's coming down. We already know that from what we looked at, right? But what do we notice? Now, could you have probably got out? Yeah. But boy, this thing went nowhere. Nowhere fast, at least, for being overbought and a cross. You basically had a cross right about there. So you were losing money for sure. Maybe you get out somewhere in this area, that's fine. Not a lot, but still enough to scare you a bit. Then you say, okay, well, we're way up here. Certainly, this is overbought. I'm in good shape. And what happens? Cross. Tried. You're probably thinking things are going well, and then boom, big scary candle. So what happened to overbought? Now, you might notice, if you're sharp, you might have already seen this. Higher high on price. Lower high on your orange stochastic line, right? Divergence, so that's a little bit stronger. So you did divergence and a recross, and then you actually were able to get that position. So why am I showing you these things? Same thing right here, right? You get a situation to where this one, right there, that cross would have been one that hurt you. Same type of thing, as you get cross right about there, you're thinking I'm good, it pops up again. Now again, you ended up getting a divergence. If you look at it right there, that would have worked out a little bit, but still, who says you wouldn't have hung out in this thing? Some might have taken some profit, and the rest they might have got caught on, had a stop loss and play something along those lines. So what's the big difference? Maybe you guys noticed already, maybe you haven't. But there's a major difference between these two things. Where stochastic overbought works like a champ, and where it doesn't. It's very simple. This is a down-sloping 200 moving average. And in a down-sloping downtrend, overbought stochastic might as well be a stop sign, right? It's painful. And I'll show you an example, where we could be running into that basically on Bitcoin right now. I'll show you that next. But ultimately, the idea is that you're in a position to where you have an overbought stochastic in a downtrend. That's a problem. That's a problem. That's a problem. Even though you got chopped out a little bit, eventually you got a great play. So all of these are great plays. Why? Because you're following a system. You're saying, hey, if my 200 is in a downtrend and my price is under my 200 and my stoke gets topped out, I want to find the short. Pretty simple, right? I mean, it doesn't get too much simpler than that, guys, right? But look how effective it is. And then on the reverse, I told some people, I said, look, Litecoin might end up being a wonderful short. I bet Neo shorted it. Neo's the old, anti. Neo wants to find tops, right? That's what it's trying to do. So yeah, the Neo called for it. I get it, but for me, I don't mind letting these guys fall. Now, when it flows back under this 200, I'm interested. But until then, at least on that scale, I can't. I just, I'll wait to see what happens. Now, sure, maybe it's way overbought. Obviously, Neo gave it the signal. That's fine too. But, Neo's just searching. Doesn't mean it's going to be correct every time. But the idea here is that you're in a position to where you're basically shorting something based on this element. Doesn't make a lot of sense. Even the, let me just see, I haven't really looked. Yeah, even the momentum has been smooth on this scale. You can see how it's ran. There hasn't been significant divergence. You have more weakness, but not actual divergence where you had a run up. It didn't pop up while your indicator popped down, right? So that's something that's very intriguing. We have to keep that in mind. So for me, I'm willing to let these guys go unless we find the proper scale. But let me review first. Now looking at the uptrend, and we could say, look at all these tops, right, that failed. Here, and there, and there, and there. I mean, these just, even if you wouldn't have lost money on some of them, they're just not trades you want to be a part of. I mean, how many times in a row did this thing suddenly go from, this one would have worked, but most of them would have been terrible, right? So you went from a situation where they're the best trades in the world to trades that you're just going to be unbelievably frustrated with. This is why a lot of people don't like stochastic. They think it doesn't work. They just don't know how to use it. Unfortunately, it's the case with most indicators. People just don't know how to use them. So the idea is we want to find the things that work and utilize it. That's it. Nothing more than that. Find what works, utilize it to our benefit, throw out the things that only work marginally. Okay, so with this, I want to use a stochastic when I'm above or below the 200, and the 200 is in an orderly fashion with my particular price that I'm looking at. Okay, so very clearly, now let's look on the opposite side of that, right? Now you might say, all right, Mr. Anderson, but what about oversold? All right, let's look at oversold. Well, we see that we've regained this 200. So when I get to a point where I'm oversold, and we'll get into the specifics obviously in another video, but if I'm oversold, the next video we're going to have more strategy about moving averages, and I'll go ahead and incorporate this a little bit stronger. I've been trying to avoid talking about the Stoch too much because I haven't given you this particular lesson, so I figured let's give that out there so I can talk more about it. So here we go. You see the difference? Look at these oversolds now. Boom. Let's match them. Boom. Oversold right there, right? And this one went oversold. There was a little recross that you would have caught you, so you would have taken a little loss there. A deeper dive, right? Recross that you might have made some money, but again, these things you got to be patient, because what happens is you end up getting a pattern in there. This one was more of a flattening type pattern, but you see almost like a little inverse head and shoulders type look to it. When you see that, that could be a beneficial scenario as well. But the idea is that here you end up getting a little fake out, a little run up again. So right about there. This one we see wasn't great, but you could have still, I see it didn't make a lower low, so you could have made a nice little run. Nothing great. It was coming off a huge pullback, so those you always have to be a little bit careful about as well. It just wasn't ready. And then it takes its time. So the idea though here is, again, an oversold, nice boom. This one didn't quite make it, so we won't even count that. This one did, right there. And what we're finding are base, right? Base, right? Great spots to look for a trade. And those trades can be very simple. All right, so stochastics oversold. Let me look for a candle to climb above the last candle. That's it, right? I mean, you see how these downtrend, downtrend, downtrend. No one takes out the previous candle. Maybe right when that candle gets taken out, you jump in there. It's probably going to coordinate with that cross anyway, or the cross might even happen slightly before, which you might do a momentum before price type trade. Here we go again. I mean, these are big gains, guys. You know what Litecoin's done, right? So the key here to these big gains has been this particular strategy. A very simple strategy. And it seems simpler than you might realize, just because you guys are learning some things now, and that's what happens. As you learn things, you're thinking, well, that's easy. Well, why didn't I know that before? Well, before you knew much about why 200 mattered, and understood some different elements of the MACD and how it works and things of that nature, these things wouldn't seem so easy. You get mixed up. Instead of doing this only in uptrends, you're doing it every time you see it, and you get messed up. So we see that works perfect. So now just one more thing to test, because we see that in an uptrend, oversold Stoch. And you remember, you're going to wait. You want to wait for a couple days. Let's bring the Stoch back up. I don't want just oversold. That's silly. No, I want either a recross, which would be aggressive, right? Or this blue line, the Stoch line, to get past 20. You could still get faked out in those situations, but you could see that other than this one, right? The majority of the time we're across the 20 again. Here, there. This line is the 20, just so you guys know. There, there, there. I mean, 80% of the time in these situations, if you waited till the confirmation of crossing that 20, it worked out perfect. A couple times you might get stopped out. That's normal. You might also catch one of these, right? Beautiful. That's a thing of beauty. So that's the benefit of knowing that you have dynamic support behind you. You guys thought we were done. Look at this guy, right? Wait a second. I think this might be a bad one. Let's see. Is this a bit? No, it worked out fine. You still got a few candles like that. You might have got stopped, obviously, on that candle, but it wouldn't have been too painful. You should remember, once you get a gain like that, don't take a loss ever. If it starts pulling back on you, just jump out and play another game another time. But what's interesting about this is that this is a beautiful example of a bull divergence. See that right there? Momentum before price, guys. That's a big one. That's why I like them. This is why I like to look at stochastics for divergences when they appear, because you end up getting a much lower low, and yet the momentum said, no, 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 I'm starting to change over, and it would have led you into this run, which you could have reasonably held on to. If you cut right here, that's fine. You actually would have done even better, because you would have re-rented at a lower price, and then yet again had another one. So we're talking about the same strategy, getting you that one and that one. And will it get you this one? I don't know. This one was weak, right? We saw this most recent one, but this is the reason why I said, hey, me personally, I'm not shorting it. Obviously, I know it looks weak because it was starting to look like it was laggering on a daily scale and some other scales for sure. But even on this, if you got weighted on the cross, the worst thing that would happen, you would have been going a little bit flat, and once you lose your candle structure a little bit, you lose that market structure there. You're not going to let it just pull all the way back. This one actually would have been a little bit poor, obviously, but still, you wouldn't have been complaining because you just reaped the rewards of what went on Litecoin. And by the way, it's not just on a 4-hour scale. If you look at a daily scale, let me clear all of this. Oops, wrong button. Wait, still wrong button. Okay. Now you look at something like a daily scale of this. Look at that divergence that played out. You would have been caught on this one a little bit because it bounced up, but if you were smart and stayed patient with it, you would have found that divergence right there. Boom to boom. And right there, higher high, lower high, big divergence, big move, right? Creeping up here, I mean, see the stochastic gets to the overbought. Some people will say, oh, you know what, the SMA has to get, your percentage has to get to the overbought too. Not really, it's not true, especially on that scale. It's not likely to happen. If you get a recross at the downside, just know that, hey, you didn't quite make it, so I'm a little bit at risk, right? Like something like this. You didn't quite make it there, so you're like, I don't know. When this one, at least when the stochastic gets in there, I could feel okay if I take a cross and just keep a tight stop until it gives you some benefits or profits, and then at that point you can consider getting in. But look at these. This is while it was kind of basing and bottoming, and these all worked very well. You can see again and again and again, right? You can imagine what goes on, in the bear, ultimately. So, when you start talking, well, this one never made it, in fairness, so you would have been on a lower scale. But the idea, though, is that in those situations, you're seeing some things that are special, right? And that's Litecoin. Now, if I wanted to short it, though, which was a good question, so I'll say, hey, you know what? What about Litecoin? Should I short it? I get it. I understand where you're coming from. I understand the reasoning. I just have been around long enough to know that, hey, these guys can go for one last gasp and show you a real divergence and burn a lot of people in the process of doing so. And it's the guys that were short, up here that end up winning when they decide that they're going to take out the longs and the shorts and come up here to a little bit higher spot. So that's why I'm leery. But what it does mean is this, and going to be my last point, I'll go ahead and finish this particular video, is that you got to find your time zone, right? Find your time frame. Right now we're on a daily, so yeah, on a daily time frame, I'm not going to say, hey, I'm taking a daily scale trade. Now, could I go to a weekly? I don't know I don't think a Litecoin has the history to giving weekly, but we'll look at it anyway. 3-day crossed even. See that right there? So it's definitely not going to have a weekly because it barely has the 3-day lines, but it's crossed on a 3-day. I mean, this thing is really strong. I mean, look at this. This is the last thing, in all honesty. This could be a great short. This thing, I'm not saying it can't. I'm not saying this can't make a lower low. It can. It absolutely can. What I'm telling you is that if you see this pattern, woo, be afraid. Like, be aware. This is something that can really explode. Because I'll tell you something else. This is above the 200. I've seen this stay for 30 days. 30 days like this. And remember, what does that mean? That means that it's at highs for 30 days, right? That's what that implies, because basically when you're up here, it means you're at the top of your range. So it's staying at the top of its range for a long period of time. Now, in crypto, it doesn't really happen that way that often, but ultimately you can see that this is a 3-day scale. I mean, it's actually already been up there. Geez, now that I mention it, hold on a second. So we're talking about 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14. I stand corrected. I've seen it for 42 days because that's what this is right here. So the reality is, I'm sure there was a lot of people that were saying right here, Litecoin's done. Litecoin's done. Look, Stoke is topped out. It's done. 3-day Stoke. That's a death wish. But it doesn't work that way, you know. Now, at that point, I could have understood it because it was under the 200, but the reality, there was no 200 as a reference, right? That 200 just came into play. So people weren't going to be in a position to play it that way. They would have had to look at this 1 day. And by looking at the 1 day, it crossed that beforehand. So it was already past it on the daily scale. And therefore, that's why you continue to see this advance. Okay? Now, if you wanted to short a very strong guy like good old Litecoin, you got to find a time frame that's in your favor, right? So what's happening here? It's traversing, meaning it's kind of hanging out. Nothing's occurred just yet. Okay, it's not what we want. Go down. We have to go down low in the beginning. Something like a 15-minute. Why? Well, on a 15-minute, it did finally lose. You know, it's been playing with it. Kind of lost a couple times. You know, so you know that's the risk. Is that we'll do a dance with this 200 because it's not sure just yet, right? But if you wanted to go ahead and attempt it, it would be something like this, where you lose it. You find a situation to where now you're under that particular 200, and right here you get a bear divergence, right? Low scale, but look, momentum, wavering, price advancing. Now remember, in this first one, you wouldn't have done too well because this thing's pretty strong on the higher time frame. So you have to be very aware of that. That hey, on my higher time frames, I'm shorting a guy that's been hot, right? There's a lot of people that are excited about Litecoin going to, much higher levels in their opinion. That's something that's realistic. So you're always fighting that. You're fighting that greed, that emotion, confidence, etc. But if you get yourself into a position to where you say, all right, I want to be short this, find yourself a nice spot like this, right? Look at this. Momentum, overbought, and we can call it overbought, because it's below the 200 on this scale. If I match that up perfectly, it's right about there. And what do we find? Perfect, just literally perfect entry into a little bit of a short. Now, you see what happens. You kind of had to deal with it again. It came back almost to your level. Fair, it would be fair to say, hey, maybe you would have covered. That's fine. That could happen. But if we're trying to find an area, you can see that it pulled down. And of course, you see a sharp move. You better be taking some off the table when these things occur, especially with big volume. Okay, big volume, sharp move. Normally, at the very least, you're going to have some sideways action, right? Which right there, sideways action, right there, advance, right? So that's why I say at the least. This is like a best case scenario. So normally you want to take a little bit off the table. And even if you love your short so much, you take a little off the table, it's going to bounce. You can add it back at a better price for yourself. So ultimately coming back to this, let's see if we got another situation. This is fine. You haven't regained the 200. In fact, you just lost it again. This would be considered a little bit of a retest that hasn't happened just yet. And if you were truly looking for that short, what do we find? Overbought, right? Even end up having a little bit of bear divergence again. Why? Momentum's higher, orange candle, orange line to orange line. And we could see the corresponding candles rose, right? So we got a nice little divergence, and this was a nice play. Would have worked out well, okay? So just find a time frame that will coincide with putting yourself in a position where we're saying, look, we want to ideally, it's not going to happen that way all the time, right? Especially when we're in a deep bear market. But if we can control it, let's short things under their 200. Let's long things above their 200. And obviously on the daily scale, we're not going to find a lot of those that match. But what we can do is say, look, let's find a scale, a time frame, where it is going to match. And then with that, put ourselves in a position to say, all right, that's the case. Therefore, I'm more than willing to short on a 15-minute and watch it like a hawk, and maybe it'll turn into a bigger trade, right? Maybe that 1 hour will go sub 200. So here we are, we see Bitcoin lost just the 200 only on the 15-minute. It's looking pretty strong on some others. I'm not going to do a review of Bitcoin right now. The 1 hour, no, it's 15-minute right there. So that's a 15, that's a 1. Let me get something like a 4 hour. Okay. So here we are on a 15-minute. So we're going to have to see something interesting coming up right now as I'm doing this particular video. This would be a good example. See what happens. It would be a good idea to tell us where Bitcoin's headed, because on this little scale, it has lost its 200 on the 15-minute scale. So we have Stoke getting overbought, and we're going to have to find out how it does. Ultimately, this could be a sign of things to come, because you don't want to lose, if you're Bitcoin, about this 39.40, you don't want to have closes under there, especially things like hourly, especially 4-hour close under that 39.40, because that's going to bring in the idea of lower numbers. But ultimately, that's it for now. I didn't want to go too deep into it. I just want to give you something solid. Give me some feedback on this. Tell me if it clicked, if it's something that you feel is going to be helpful for you. And if you need me to go deeper into it, I'm happy to do that as well. We can kind of try to pace it. If you give me quick feedback, I can pace it around those next videos to put some little additives in there. I didn't get much into the comparison of the RSI relative to it, so it's not necessary. It's just if you can kind of understand the differences, that the RSI, the reason why I like to, I'll look at both. I'm going to tell you one more thing. I'm sorry to extend this video, but I'm going to tell you one more thing that's important. Do not utilize the stochastic and RSI together in a manner to where you're going to say, oh, look, bear divergence on the stochastic, right, which it was, right, on a low scale, 15-minute scale, that gave you that. And also, this didn't happen here, right, so the RSI disagreed, right, the RSI showed a nice advancement there. You see that? That's okay for them to disagree. For me, like I said, I trust that Stoke a little bit more. Just telling you, that's me, my personal thing. You might trust RSI more, and that's okay. There's nothing wrong with that. But for me personally, in history, I'm an SMI guy, which it's a little bit different indicator. That was something that I traded with. Literally, I traded with a couple lines on my screen, the SMI, which is very similar to stochastic, and nothing else. And I did that for many, many years, and they were smooth sailing times. Okay, so I do have a little bit of a special place in my heart for something like a stochastic. I'd rather teach the stochastic than the SMI. Perhaps much further down the road, I'll do like an advanced course of SMI, because it's a little more technical, a little more advanced, and it's a little bit harder to read. But once you get it, it's a beautiful tool. Okay. The SMI, interestingly enough, though, doesn't have the same effect in crypto as it does like in the stock market. We'll talk about that when we get into that. Not to be sidetracked, the point I was trying to make here is I wanted to let you know that if you're comparing Stoke and RSI, just understand that they are measuring the same thing, which is momentum. So they happen to disagree here, which is fine. Ultimately, the key is I don't want you to ever be in a situation where you say, hey, I'm getting bear divergence on the Stoke and bear divergence on the RSI, so therefore I really love this trade. No, 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 no. And I'm going to tell you why. Okay, if you've heard of something called multicollinearity, basically that's the process to where you're taking a study, right, and now utilizing another study of similar accord, right? So these are both momentum. They're basically measuring momentum of this price. So I cannot use this particular indicator to support my view of this indicator. No, 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 no. These are both views of price, right? So in doing so, it's basically just the bias at that point, and I'm finding ways to justify my bias. I don't want to do that. I don't want to do that at all. So look at them if you'd like. At the same time, in all honesty, I don't typically, I guess I do because I keep up a screen. It's just I'm so used to knowing not to do something like that. I just want to make it very crystal clear to you guys. Never put yourself into a position where you're saying, hey, these agree, so I love them. Hey, most of the time, they're going to probably agree, and if they don't, that might be the positive. See, in my mind, I want to see, hey, maybe I might find where they don't agree. Oh, okay. Like this example right here. Now, RSI stretched. Okay. So some could say, all right, well, Momentum before price, believe it or not, they were both correct. This is an intriguing thing. This is why I like to look at Stoke, right? Because the momentum was here, right? So see this line? You can try to concentrate on that one. I'll try to make this one bigger for you real quick. Okay. Again, I think it's a little bit important, so I want to point it out. So we can see that the RSI stretched higher, right? And it stretched higher even than this particular level right there. But what happened with price? Same scenario occurred. As the RSI stretched higher, price followed. Maybe they were in unison. Regardless, it happened. The difference here is now, first of all, Stoke might have done that because this is a reversal candle, but we do see that on this green candle, Stoke was lagging already because this is already at the higher level. Stoke is already still at a lower level. So Stoke gave us some insight there, but the reality is momentum before price did occur in one sense in that, hey, price did go higher. It just happened to immediately reverse. But in this particular example, the Stoke gave us the clearer view. And what really was happening is that it was happening on a bigger scale. So, with the RSI, it moves quick, right? And the reaction might be quick, so sometimes you miss it. With Stoke, it's a little bit more delayed, right? Because we're talking about a smoothing, we're talking about a 14 scale with a moving average on top of it. And a lot of times you can see a little bit of a move. Now, how long? You can't count on this to be 10 candles long, but if it's 4 or 5, great, that's a benefit, and then you kind of have to TA from there. What do I mean by that? So I get my signal, I entered here or even here, right? And then it's all right, a couple candles and it's dropping on me. Good. At this point, does this signal still apply? No, now I'm doing TA. Now it's like, all right, well, if I gain above this candle, I want to get out, right? I don't want to regain these moving averages. So you watch it, all right, things are falling great, and you would have fell into a trade by accident, basically. That turned out to be a monster, and when you see that volume, you should definitely sell. All right, guys, hopefully you're understanding where I'm coming from with this. We're going to get much deeper, so I don't want you to think like, oh, man, I'm not getting it, it's confusing. First of all, rewatch it a few times. This is important stuff. Now we're like really getting into things that are going to truly make you money, especially if you know the other material already. Okay, I think you should be able to see that. You should have been able to see that, hey, wait a second, I'm finding out about something very important, which let's go and look at it here. Bitcoin, same thing, very quick, right? When these things occurred, overbought below the 200, what do we get? Some sort of drop, right? And that might not look like a drop, but it's a drop, right? And this is during the recovery, right? Same type of thing. Overbought, drop. Didn't reach overbought there, but look at this one. The good thing about this, you might say, whoa, wait a second, it happened here. Well, remember, you're going to wait till it crosses, right? So there's the cross right there. So overbought, but now it's testing at 200, so you would have left that alone, but even still, it dragged down and relaxed a little bit. Now, if we go back to the drop, of course, everything was dropping, but you could see how well this worked. What happened? First try, overbought, under the 200, good night, right? Now, at that time, what I was telling everyone is don't try to long things in a bear market, but ultimately the reality is here's how you play these particular things. If you're fortunate enough to get to this overbought, it's a short. You understand? That's the idea. 9 times out of 10, you're going to end up with a nice short. In this case, even when you don't, like this one, when it started to climb, first of all, you would have noticed, like, hey, it just climbed above the 55. Maybe I should see how it reacts to these crossover EMAs. But if not, even if you took this trade on this cross right there, what would have happened? A few sideways candles. Maybe you took a little bit of a loss on that candle. It still wouldn't have hurt you that bad. But for the most part, you're going to go ahead and pay attention to these 200s. Obviously, see what's going on with the moving averages. If you're in the midst of a move here, then this would probably be a no trade zone. But ultimately, you can see the benefits far outweigh any risk in these situations. And of course, on this scale, it only happened, right there, etc. But those were wonderful trades. All right, that's it for now. I went way too far. I apologize. We'll talk soon. Mr. Anderson signing out. Hopefully you enjoyed Stochastics. Now we're going to integrate this further and further into moving averages. We're going to go very deep into moving average strategy, so be prepared for that. It'll be fun.